Chris, what is the quality of this record high versus the past? Because when I look at what the Nasdaq is doing today, it's headed for another record high. Microsoft, Amazon, and Google are leading the way. These are what Strategas calls tech staples, internet and software darlings of the yesteryear, which are now cash-generating behemoths.
Yeah, I think there's two distinguishing factors between this new high and what we saw in 1999. And number one, sentiment is not euphoric. There's no champagne being popped. There's no balloons. There's no confetti.
You don't have a baseball hat with
no.
Nasdaq?
I think there's a. I think investors are generally still very agnostic towards equities. I think that's reflected here in this subdued optimism. I'd say number two, when you look internally at this market, in 2000, only 1 in 4 stocks were in an uptrend at that March 2000 high. Today, it's 7 out of 10 stocks are in an uptrend. So internally, I think the picture is still much firmer than what we saw at either of those 2 points.
Well, plus companies back then in the Nasdaq weren't actually making any profit, right? I mean, that's got to be probably the biggest defining factor of this rally compared to the last.
Right, yeah, looking at the forward P of the Nasdaq Composite right now, it's about 22, 23.
Which is nothing. I mean, it was at least 10 times that.
Yeah, and looking at the bubble era, it's almost an imaginary number at that point. So many companies were unprofitable that, you know, you can't even really compute an accurate one. But to me, what's interesting is some of the biggest, you know, the tech stalwarts, as you call them, or whatever you call them.
Tech staples.
Tech staples.
Yes.
You know, you look at some of the biggest companies in the Nasdaq, Apple, Microsoft, Cisco, Intel.
You can call them blue chips.
Even Gilead.
Actually, those companies, right?
These stocks are all trading basically at a discount to the overall market. So that, I mean, there are some overvalued stocks in the Nasdaq, obviously. You know, we talked about Amazon earlier. You know, Amazon, you know, is unprofitable, but it's not Webvan, you know, it's not Pets.com. Obviously, Amazon is a mature company that has a ton of earnings potential there. It's not really taking a flyer on this big, huge speculative bet. So I think
Scarlett said earlier, Amazon's not a tech company, by the way, and a lot of people think it's a real retail company. But this is a company that's not profitable because management chooses not to be profitable.
Right.
Precisely.
They can flip a switch and make a hell of a lot of money next quarter.
I think when you look at Amazon, it's a consumer company, but it has those tech elements. But what's, I think, more important is the leadership backdrop right now is also very supportive. You have cyclical groups that are leading this market higher. It's not the defensive backdrop that we saw even last year. So when we look at consumer staples led by Amazon, when we look at some of the old tech names, Akamai looks fantastic here. Facebook is strong. Apple is still quite cheap. We think the market's in pretty good hands from a leadership standpoint as well.
I want to go back to what you said about how investors are agnostic. What does the fund flows show you in terms of money moving into, say, Nasdaq stocks versus the S&P and Dow, which made plenty of record highs in 2014?
Well, this year, the money's gone to Europe.
Yes.
If you look at fund flows into the SPY, which is the S&P ETF, over the last 65 days, they're actually negative. That doesn't sound like euphoria. That sounds like indifference. There's a series from AAII, which is retail investors, that measures what percentage of retail investors are neutral on the market. That's one of the highest readings in 2 decades. That's shoulder shrugging and indifference. That's not irrational exuberance.
Chris, one thing I'm interested in, obviously investors have it ingrained in their mind to buy low and sell high, but one of the things you look at a lot is stocks that are breaking out into new highs and trying to gauge whether or not they have momentum. You know, why is that important, and does this breakout in the Nasdaq really signal, you know, more gains could be coming?
We love relative strength. We like owning leadership, especially in a market that's basically been sideways much of the year. Yeah. You want to own what is giving you alpha, what is paying you to own it. And tech, certainly mid and small cap tech especially, has been very good this year. Healthcare is still leadership in our work. Consumer is still leadership in our work. Don't fear the new high list. It's often very viable.
Still, we are range-bound, though, when you look at how the indexes have moved, especially for the S&P 500 and the Dow. The Nasdaq may have broken out, but the S&P and the Dow are still caught in this range, and we're not doing a whole lot in 2015.
I think what's curious is that the average stock is doing better than the index. So if you look at the value line index, it's 1,700 equally weighted issues. That made a new high. The advanced decline line on the NYSE made a new high. Russell 2000, mid-cap index. Most of Asia, most of Europe. So rest of world and under the surface here in the U.S. is actually acting better than the index would suggest.
Do you worry about, I'm just pulled up the short interest ratios, and I'm seeing them down at least full 1-year lows, around 2.2, and we were up above 8 in December. Does that concern you? Because a high short interest actually, although it sounds bad, is a pretty good thing because it provides a cushion for a drop.
I'd say in aggregate, the data is mixed there, and I'm just not yet willing to call sentiment too complacent. If you look at put calls, they're neutral. If you look at stuff like option skew, it's neutral. So I don't think we've seen the full package of the sentiment data suggest that point. And then also, I think the fund flow data, as we talked about, would suggest there's not a lot of money behind this move. So there's actually opportunity for more money, I think, to come into this market.